to the Mortgage Minute. I'm so glad you could join me on this Monday morning. And today's topic is going to be the different types of loans that you can get, or different types of mortgage loans. I know when I first meet with a couple or with an individual, when they come in, unless they have a lot of experience, they quickly become overwhelmed. So, number one, the first thing is going to be get with an experienced lender who will take their time and look at your personal needs and wants and desires and capabilities and match you up with the right loan. Give you the different options and let you kind of choose what is going to fit your profile the best. All right, first of all, our most popular loan is our conventional loan. Those are the ones that they require the highest credit score, and they also require more down. Now, you can get a special conventional loan with 3% down, but typically you start with 5% down. If you do not have 20% to put down, then they're going to require private mortgage insurance. And I know a lot of people kind of complain about that, but really it's set up to help you guys. Because in the past, what would happen is if you did not have 20% to put down on a loan, then you could not get a mortgage loan. So they came up with this program that will help and insure the loan, or it's like an insurance that backs it up, similar kind of to your homeowner's insurance. But this is just for the loan. And what would happen is you can put down 3% with those, 5%, 10%, 15%, down to 20%. And as you decrease with your loan amount, which means you increase your down payment, then the private mortgage insurance is cheaper each month. Now, that can be paid up front. It can be financed into your loan amount. It can be a monthly premium, or it can be split, where some of it's up front and then some of it is monthly. You know, again, you're going to kind of work with your lender to see if you go conventional, which route you would rather go without your 20% down. Those, again, do require the higher credit scores, and most of the time it's going to be 620 to 640 and higher. Then also, the rates are typically a little bit better than with the government, or if it's not, because of the insurance, it offsets it. So that's kind of your premium product that you're going to go for. Then the next loan is going to be FHA. Now, rather than being backed by private companies, the FHA loan is backed by HUD. And with that loan, you're required to put down 3.5% unless you get a special HUD foreclosure where you put down $100. And those, they're notated, and those are special circumstances. But with the FHA, your credit score can go down to 580, and your total debt ratio can go up to 55%. And what I mean by both of those, your credit score, as you know, we will pull 3 repositories. We've talked about that in the past, and we will use the middle one. And with the we have an automated underwriting system. We run it through, it comes back, and it gives us what we call our findings. We go over those with you and kind of tell you exactly what we're looking for. And one of the things is your total debt ratio can go to 55%. Now, for total debt ratio, what that means is we take all of your monthly debts, we add your proposed house payment, and then we divide that by your monthly income, your monthly gross income that you have. The next type loan is going to be our VA. Those are great loans, but you are required to be a veteran, and they have certain stipulations. The great part is you can do a 100% loan with those. They do require an upfront premium. Now, when I'm talking about collecting these upfront premiums, it goes back to the agency that is guaranteeing it. For example, with the FHA, the upfront monthly premium goes back to HUD. With VA, the upfront premium goes back to the Veterans Administration. With the USDA, the upfront premium and monthly premium goes back to the Department of Agriculture. Now, with the VA, your total debt ratio can go up to 55 also, and your credit score can go down to 580. And again, once again, we'll run it through this automated underwriting system, because the system looks at numerous things. They look at your credit scores, they look at the amount of reserves that you have, and they look at the total debt ratio. So it's an overall picture, and they look at a history of your credit, how you've paid in the past. The fourth type loan we have, and it's the third government-backed, is our USDA loan. The USDA loan is income-based, meaning you cannot go above a certain level of income, and that's household income. That means, let's say you have a son or a daughter living with you. They're going to count your income, your spouse's income, and your child's income. And they add all those together and they make sure that it does not exceed the amount that's approved for your area. And every area has different amounts. The credit scores on these typically 620 to 640 unless you go into a manual underwrite. Now these are designed, they're backed by the Department of Agriculture, and they're designed for your more rural areas. But you'll be surprised what's really a rural area. For example, the majority of the city that I live in, Hattiesburg, up until you get down to Midtown or right downtown, most of our area is USDA approved. Our little surrounding towns, Purvis, 100% USDA, Summerall, 100% USDA, Petal, all of this area is USDA because Mississippi as a whole is really a rural state. These are great programs, great loans. They have an upfront premium and they have a monthly premium. Now, this monthly premium is much cheaper than your FHA monthly premium. So most of the time when someone comes in, that's the loan that I try for first if they need a government-based one or backed one. Then I would try the FHA loan, unless they're veterans. Of course, if they're veterans and they want to use that, we go for that first. But that's just a little bit to tell you examples of the main different types. These are what we call our vanilla type loans. So your conventional, your FHA, VA, and USDA. Now we have a whole group of what we call portfolio loans, and they're specialty type products. And we'll go over those in another video. But thank you guys for tuning in today. If you have any questions, get back with me. I'd love to work with you.